I'd like to start with a brief summary of your takeaways from both the skip or pause from the Federal Reserve yesterday, but also from the Bank of England today. What are the pros and cons of not doing anything here, Bob?
Yeah, well, thanks so much for having me right here in the central bank bonanza. I like to say here doesn't get more exciting than this for the macro set. I think what we're seeing at the big picture level, sort of known as we were coming into this, was that the major developed world central banks are looking for a reason to pause. They really think that. I think they're wrestling with the question of the trade-off between weakening growth and inflation. I think we were getting a good sense as to what their reaction function is and what their priorities are. And the short of that, in terms of their priorities, is that they're willing to stop tightening not just before it's certain that inflation's coming down to their mandates, but before it's even obvious that we're moving meaningfully in the right direction. And so what we're seeing, but a little less from the Fed, a little more from the Bank of England, the ECB, and some others, is that they're prioritizing their concerns about growth ahead of fulfilling their inflation mandate, and are comfortable with a dynamic where even in the best of circumstances, inflation is moving back down to mandate, let's say, in 2 years, and they're okay with that. So all that speaks to a set of central bank activities, at least, in the medium term, let's call it 3, 6, 9 months, that are going to be comfortable with elevated inflationary dynamics across these economies.
Before we went on air here, Bob, I made a heat map of forward pricing of all of the major central banks across the globe. And over the next 12 months, the Bank of Japan is the most hawkishly priced central bank on earth. Then something is wrong, right?
When's the last time that happened? Probably 1989, right?
Yeah. It's got to be decades back at least. But if you look at the prospects for further rate hikes from the Fed, Bank of England, maybe even the ECB, do you think there is a path ahead for them where they can actually decide on rate hikes again, despite this pause rhetoric that they've used over the past couple of meetings here?
The short answer, I think, is no. I don't think that those central banks, in a time frame that those of us who trade markets really care about, are going to move to tighter monetary policy. I think, they've basically made their bed when it comes to saying that they're, at, or maybe there's 25 basis points more or something, but I don't really care about that. What we care about is, are they going to meaningfully re-enter a tightening cycle anytime soon? I think the answer is no. They think they've done enough. And frankly, they're making a big bet on the fact that the disinflationary forces and the work that they've done so far will eventually get inflation back down to their mandate. Now, I think the thing that's interesting about that from a trader's perspective is what that does is it puts a lot more weight on the long end of the curve. And that's exactly what we're seeing. Typically, if you were, if you go back to the 2007 cycle or the 2000 cycle, when the central bank stops tightening, when you get that pause, that would typically be a good indication to buy bonds, right? Because the central bank is no longer essentially dragging up the yield curve with their activities. But as we've learned in the last couple of days, it's exactly the opposite, right? Bonds have been selling off despite the fact that these central banks have paused, and even in some cases sort of dovishly paused relative to expectations. And the reason why that is because the fact that they've paused before we've meaningfully gotten inflation down to mandate or close to mandate means that the inflation problem still exists, right? The risk of the inflation problem still exists. And what that means is that the long end is repricing that dynamic. Like, the worst thing for the long end today is that central banks don't tighten aggressively. And the best thing is that they do. And that's a little counterintuitive, but you can see it in the market action. That's the reality of what we're seeing. And so, it's up to the long end and the market-based tightening to get the job done right now.